Hey guys, Michael Williams here, Southern North Georgia's team, part of Keller Williams Greater Dalton Realty. So a lot of financial news over the weekend that directly impacts the real estate world. So that's why we're going to cover it here today and going to jump right into it. So Silicon Valley Bank was the second largest bank failure in the history of our country. So it's kind of a big deal. It was the number 18, I believe, largest bank in the country. And so while it is a big bank, it is still technically a regional bank, and it kind of fell under some of the stress test limits of the larger banks that they have to go through, like Wells Fargo, JP Morgan Chase. Those banks had to go through a lot more stringent regulation than a regional bank would. And so it kind of fell into that second tier of not getting as much scrutiny as some of the larger banks. So anyway, that bank failed on Friday and the FDIC took it over. So one of the big problems at SVB, which is Silicon Valley Bank, one of the big problems there is that there were a lot of deposits that were over the FDIC insured limit. So if you have more than $250,000 in an account, that balance above 250 is not insured by the Federal Deposit Insurance Corporation. So basically what that means is you've got some risk if you keep more than 250 in the bank, which 250 sounds like a lot to most of us, certainly does to me. There are venture-backed startup companies in the Silicon Valley that raise millions of dollars at a time to launch these companies and try to make millions of dollars. Think Facebook, Twitter, Instagram, those types of companies. So as they launch those companies, they require large deposits into banks, and they've got payroll to make just like any other company. And so, there's a lot of, I guess, good reason to have higher balances in those banks. But if you get over that $250,000 limit, it's technically uninsured. So what happened on Thursday of last week, one of the larger hedge fund guys that has a lot of VC-backed money, venture capital money, he told a lot of his companies to withdraw their funds from Silicon Valley Bank because he recognized that the bank had not been doing a very good job of mitigating their risk. Not to get too far into the weeds, just to understand that the management at the bank wasn't doing a very good job of risk management. So they needed to go raise some capital. They knew that probably about a week ahead of time because there were some significant stock trades where the senior management were basically dumping their stocks ahead of this news happening. And so they tried to go raise some money, and that actually was the signal to Peter Thiel, the main venture capital guy that pulled all his money out or told his companies to pull their money out. So that's what started the cascade. And then once the bank run started, they basically did not have enough money in the bank to cover all of the depositors. So when that happens, you have a bank failure and the FDIC takes over. So basically, all of the depositors at the same time wanted their money out. We have a system called the fractional reserve system that basically allows a bank to not keep all of your money at the actual bank. And so when that happens, they don't have enough. They can't get their hands on enough money to cover the deposits that are being demanded. And typically, not everybody demands their deposit at the same time. So that's why this fractional banking system works. Until it doesn't, and everybody asks for their money out at the same time, then that's a problem. So at any rate, that's what happened. But really, you're here to listen to me, most likely because you want to hear about real estate and what's happening in the real estate world. So here's how I see this whole thing playing out as it affects the real estate world. So first, I will say that this may uncover some other problem banks, but it's unlikely that this is going to be widespread through the whole country, that we're going to have bank failures everywhere. Very unlikely that that's going to happen. One of the primary reasons is that a lot of banks, especially in our area, do not cater to large startup companies that have millions of dollars through the venture capital world. That's just not who we are here locally. We have a lot of what they call mom and pop bank customers. So they're working at the mill, bringing their money in, or a lot of them, let's say they own the mill. They have much more widespread liabilities, I guess is what you would call it if it's a bank deposit. But anyway, the point is that it's not centrally located to a VC world. So unlikely that this runs into other problems. There may be 2 or 3 other banks that have not been doing a good job of risk management. So that could be a problem. But I don't think any of our banking folks here locally in the North Georgia area are going to see any problems from this. It's unlikely that that is the case. So knowing that, how does it affect our real estate? Well, I can tell you this. I checked the 10-year Treasury a few minutes ago. It's down to 3.4 for the interest rate on a 10-year Treasury note. That's significant because on Thursday last week, it was 4. So it went from 4 to 3.4 in a matter of basically 2 days, maybe 3 if you count today as a business day that is just now getting started, and the 10-year seems to be continuing to fall. So the reason the 10-year Treasury is important is because that is the bond, I guess you would say, that most directly correlates to the mortgage rate. So if the bond that most directly correlates to the mortgage rate fell by over 0.5% in 48 hours, then first of all, that's one of the biggest drops in history. Second of all, that means that mortgage rates are likely going to go lower. So congratulations if you haven't locked in your loan yet and you're shopping. That's good news for you. If you have locked in, there is a chance that you may need to float down or relock with a different bank. We'll talk more about that later, but just know that very likely lower mortgage rates are happening this week than what you had last week. It's a black swan event. There's just no way we knew this was coming. So last week we were told that rates were going higher. The Federal Reserve talked about doing a 50 basis point raise. And so everybody thought we were going to go much higher as late as Wednesday of last week. And then Thursday happened and everybody kind of got a little afraid, kind of thought for a minute, oh, this is not good. Friday, it was apparent that that bank was going to fail. And a second bank, Signature Bank in New York, failed on Sunday. So that has also been taken over by the FDIC. Again, they were a bank that was very dependent on larger depositors. So just know that it still doesn't affect us here locally all that much. But anyway, with lower mortgage rates, what happens? Well, I can tell you from experience, when I've seen rates fall quickly, it's because there's a lot of fear in the market. And so if there's a lot of fear in the market, that may mean that even with these lower mortgage rates, some buyers may get a little spooked. They may sit on the sideline for a couple of weeks just to make sure that nothing else crazy happens, which, might be warranted. I'm not here to say you should be a buyer or should not be a buyer, but I will say that typically when I've seen things like this happen, buyers get a little scared. Buyers get a lot scared, let's be honest. And so it's likely they might sit on the sideline. If that is the case, it might actually be a great time to buy, because I can tell you this, affordability is going to be way better this week than it was last week. If you've got a mortgage rate that's 0.5% lower than it was the week before, man, what a great opportunity that is. So that might be a trigger for you, that if you've been sitting on the sidelines, now might actually be the right time to buy. You're going to have less competition, you're going to have a lower mortgage rate, and so maybe this is the week that you need to get out and start looking. Who knows? I'll leave that up to you. Another thing that I would tell you is you might find a seller that is motivated this week that wasn't motivated last week. There are some folks that tend to overreact to news like this. Sure, it's bad news that a bank fails, but is it worth overreacting and marking down your property by tens of thousands of dollars just to unload it because you think the world is ending? Might not be the right move, but if you're a buyer, maybe you get lucky and you find that seller that overreacted. There was somebody on my Facebook feed that said that people overpaid by tens of thousands of dollars. I think he might have even said hundreds of thousands of dollars. But anyway, if he thinks that people overpaid for housing over the last couple of years and he owns a house and he thinks that he can still get that overpayment of tens of thousands of dollars, then he might list it and try to sell it because he thinks the market's going down. And he may take less because he's afraid of where the market's going to go. And so if that's the case, then maybe you should buy today. I can tell you, I bought in July of 2020 and I bid, I think my house was listed at $219 and I bid $267, which at the time looked crazy. It looked like I was way overpaying, going almost 50 grand over list price. Looked like I was overpaying. But today, I owe a lot less on my house than it's worth. So just understand that in the 2020 world where it looked like I overpaid, I actually got a great deal, because you can't find that deal today. So there are a lot of people in 21 that looked like they were overpaying, but now they have a rate of 2.75% that's locked in for 30 years. So their payment is much lower than the guy who bought in 22. That guy also paid a little bit of a premium, probably 8 or 10% above what he would have paid in 21. And he also got a much higher rate. So he's probably in the 5s or 6s. So just because somebody thinks you're overpaying, that doesn't necessarily mean that you are. If you get a rate today of 5.125 and your buddy got a rate last week of 7, well, you can afford to overpay a little bit, and you'll still get a better deal on a monthly payment than your buddy did. So anyway, I just tell you that to say, if you're in the market and you're thinking about buying a house in the next couple of weeks or going under contract in the next couple of weeks, this might actually be a good time. Rates look like they're going to be a lot lower today than they were last week. So keep that in mind. Prices of real estate have not changed all that much year over year. A couple percentage points one way or the other, depending on which part of the market you're looking at. But I can tell you this, we just did this analysis last week. There's really a story of two different markets that are happening. So you have the under median sell price, super hot. We had 42 active listings and 75 pending. So that means for every 2 houses almost that are pending, there's only 1 available. So that side of the market, super hot. When you look at the over the median, that side of the market slowing down. There are, 83 pending and 107 active when you go over the median, which the median sale price in the Dalton MLS was $230. So if you look under $230, super hot. And as you guys know, if you've been looking for houses that are $200,000, hard to find one that's available. When you look at the over 230 market, it starts to slow down a little bit. When you look at the over 500 market, much slower. Over 900, again, much slower. So just keep in mind that when you read the news and you hear the news, I just gave you the real numbers. So understand that the market is still super hot if you're looking for entry-level housing, or basically below the median, that first step of move-up buyer. Maybe you're going from a mobile home to your first site-built home, or maybe you're going from an apartment that you're renting into a home. That side of the market is really hot. So if you're an investor and you're trying to decide if you want to flip a house right now, I personally think it's a great idea to flip right now. If you can find a home that's in disrepair that you can get for 100, and you can go put 30 grand in it and you can go sell it at 180, then that is a great profit margin, and that is a great place to be. We certainly do not have a problem selling homes under 230 that are move-in ready. There's just not many of them on the market. The ones that are on the market sell in days, not weeks and not months. They sell in a few days. So, all right, that's my rant. This one's been long enough. Good luck. If you got any questions about the real estate market, let me know, or the economy in general. I probably need to address a couple things I've gotten on TikTok lately. There are some folks that think that I don't have the authority to be talking about economics because I'm just a lowly real estate agent. And I feel like I probably just need to say this so that the world knows. And so I have a certificate to teach economics, and I study this stuff all the time. So just understand that I may be a lowly real estate agent, but I also have the right to teach economics at your local high school. So keep that in mind. Y'all have a good day.